Jim Cramer on April 7th came on his show and warned about a potential Black Monday event, inferring that the stock market could see a dramatic additional 20% decline from that moment. He said this right here, and the stock market proceeded to rally by over 10% just over the next trading session. This is exactly the type of information on financial media that is spread to trick and trap you into making poor decisions during volatile times. It's specifically in instances like this where you should ask yourself, am I dumb money? If you're not sure what the answer is, you should probably refrain from making trading decisions. Today, I'm going to show you what our approach is in these volatile markets, both longer term and shorter term. By the way, there's just a couple days left to take advantage of the 30% discount that we're doing on our service to celebrate hitting 500,000 subscribers on YouTube. If you want access to all of our trades and learn everything I know about trading, make sure you don't miss it. We've helped our clients throughout the 2024 bull market with some pretty incredible returns, significantly outperforming the S&P 500, and we're also very proud of the conservative approach that we've recommended so far throughout 2025. And as I'm going to show you in this video, we're going to see huge opportunities coming out of this. Stock market volatility, as measured by the VIX index, has spiked to levels only seen twice going back to 1990. That was during the COVID pandemic and the Great Financial Crisis. When the VIX is above 30 like it is today, the average daily S&P 500 move is about 3 to 5%. When the VIX is below 15, the average daily move is about 0.3 to 0.5%. So that means the size of the moves that we are seeing on the S&P 500 right now are about 10 times greater than they are when volatility is low. This is not a moment to be making life-changing decisions regarding your investments. It's not the moment to pour your life savings into S&P 500 call options, and it's also not the moment to go all into S&P 500 inverse ETFs. In our experience, the most profitable trades and the most incredible returns can be made when market volatility is low. When volatility is high like today, unless you have an established track record of being able to navigate these kind of conditions, you are going to get ripped apart. There is one thing that you can do, however, in these volatile conditions. You can take advantage of these spikes in volatility that often correspond to large corrections in stocks to make long-term portfolio investments. And when I say long-term, I mean over 10 years. When investing with a long-term horizon in mind, the only thing you should care about is the stock market's valuation. When we look at the S&P 500's valuations, measured by the PE ratio that tells you how expensive the stock market is based on the earnings of S&P 500 companies, we see that the PE ratio has moved from 22 down to 18 in this recent correction. So that's about a 20% haircut in stock market valuations, which makes stocks about 20% more attractive on a 10-year investment horizon than just a couple of months ago. Now, could valuations go lower in the short term? Absolutely. But over the long run, the data is very clear. The cheaper you buy stocks, the higher your expected return on investment. And that's exactly what this chart shows. The higher the PE ratio of the stock market, the lower its expected return on investment. This is using data going back to 1985. And historically, it shows us that when the PE ratio of the stock market is 18, you can expect about a 5% annualized return over the next 10 years. Now, 5% is not incredible, I'll give you that. But it is much better than the return on investment you can expect from the stock market when the PE ratio is at 22, which historically provides a negative annualized return over the 10 years that follow. This is why you never heard us talk about long-term buying opportunities throughout 2024, because stocks were just too expensive for that. Now, we're starting to see that change with this recent correction, where you can now actually expect positive annualized returns from the stock market over the next 10 years. But now look at what happens when we plot 1-year returns instead of 10-year returns. There is almost zero correlation, meaning that buying expensive stocks can lead to pretty good results over the next year, and buying cheap stocks can lead to bad returns over the next year. So cheaper valuations on the stock market does not necessarily equal strong stock market performance. So PE ratios are not something that we use to make our trading decisions at Bravos Research. And just because stocks are cheaper doesn't mean we're going aggressively long on stocks right now. Throughout the greater part of this correction, we've had an extremely limited number of new trades on our website. Because ever since the S&P 500 broke down below all of its key moving averages right here, we've been very upfront about not knowing what is going to happen next and not looking to be a hero by making big calls on the market. The only thing I can tell you right now is that when this pullback does come to an end, and it will come to an end, on the other side of all violent market corrections are nice, long, steady bull markets with plenty of opportunities for traders who have patiently waited and are ready to look in the right places for outperforming stocks. In 2021, Apple, Amazon, Google all rose by over 100%. In 2024, Tesla rose by 200%. Bitcoin also rose by 200%. Natera Incorporated rose by 350%. Elf Beauty rose by 800%. These are all trades that we were able to take advantage of at bravosresearch.com because we were focused on picking outperforming stocks and assets during favorable market conditions. But if we let ourselves get ripped apart by volatility during these kind of corrections, then we won't have anything left to trade with when the next bull market begins. At this point, if we rewind to 1998, we can see what the best case scenario for the stock market can look like. A big, violent 20% correction, making the S&P 500 slice through all of its key moving averages, followed by generally choppy price action, but ultimately a big, nice recovery above the moving averages. This was the signal that stocks were going to continue their bull market for the foreseeable future, and indeed stocks continued to move higher for another year and a half afterwards. This is the worst case scenario. Stocks declined by 20% from their all-time high, and although they attempted to bounce and recover, the stock market never managed to get back into a constructive technical structure. Sellers stayed in control of the market, and the bear market continued. Today, we are simply watching if stocks are able to recover back into a bull market structure. Trading is not rocket science. It's about discipline, and it's about knowing when to sit on the sidelines. The problem is 90% of people cannot just sit still during these kind of market conditions. So if you want help staying level-headed, understand today's market environment, and get access to all of our trading decisions, take advantage of the 30% discount that we're doing on our website. I look forward to seeing you there.